Hello, everybody. Ed Yardeni here. Thank you for joining me today. It's a beautiful day here in Long Island, sunny, and expected to be something in the 60s, which is pretty nice this time of year. The New York Marathon on Sunday had great weather, so we didn't go, but watched a little bit of it on TV. And so I'm here with Max, always dependable, always dependably taking a good nap here while we're doing our discussion. Lots to talk about, clearly. Not only is it sunny here, but it was a very sunny week in the markets last week. This is a pretty light week for economic indicators, so I don't know that there's anything that'll come out that'll suddenly change everybody's perceptions one way or the other, make everybody feel more bullish or more bearish. So there's not much going on. I think the Sluice report comes out today. I haven't seen it yet. That's the senior loan officer survey that the Feds puts together, but it's going to show what we know, that they're all saying that credit conditions have tightened. Look, if the Fed's doing a survey of your bank and wants to know if you're tightening credit conditions, you're not going to tell them, yeah, well, you raise interest rates 500 basis points. We're still lending like drunken sailors to other drunken sailors. They're not going to do that. So yeah, credit conditions have tightened for sure, and we can watch that not on a quarterly basis, which is what the survey does, but we can watch it on a weekly basis with the data that the Fed puts out on commercial bank assets and liabilities on Friday. And sure enough, things are slowing down. They're not going, grinding to a halt. What really is happening is we're seeing C&I loans actually are actually flat on a year-over-year basis. So I guess you could say that's grinding to a halt. But I think some of that is related to the fact that following the crazy inventory swings we've had over the past couple of years, I think companies are kind of settling things down and maintaining inventories at a good level, but not doing anything crazy in that regard. We're seeing some weakness in the growth rate of consumer loans. Auto loans are down on a year-over-year basis, so that's clearly a factor in possibly depressing auto sales, though auto sales have been kind of holding up. So there must be people out there who still have liquidity or, somehow or other don't mind financing at these current rates that are still buying cars. So we're not seeing a kind of a classic auto recession in the face of a fairly substantial increase in interest rates. But the economy, I think one of the reasons the market did well last week, the stock market did well, is because the bond market did well. There's an article in Bloomberg saying that the hedge funds had massive short positions at 5% in the bond market. So a good part of last week's rally in the bond market was probably a short covering rally, but that's a healthy development. Suggests to me that we may just mosey around 4.5% to 5% on the long bond for a while here. We may not have to fret that it's suddenly going to spike up above 5%. Very unlikely that it'll drop below 4.5% unless we're suddenly talking about a recession. Now, the employment numbers were on the weak side. A good chunk of the increase was in government jobs. But then again, we also had strike activity in the auto industry that slice off 33,000 jobs from the payroll employment report. So that needs to be factored in. Meanwhile, there's plenty of other job indicators suggesting that the labor market's doing just fine. Job openings are still plentiful, which means that maybe some of the weakness we're seeing in employment is related to a shortage of workers. And you would think that would lead to much higher wages, but wage inflation is actually continuing to moderate. And it looks to me, based on some of the data we got last week, and I think it was actually the most important data that came out last week, I believe it was on Thursday, the productivity and costs number came out for the third quarter, and it showed a big increase in productivity, and unit labor cost inflation came down very sharply, and that's very important for the underlying trend in the CPI inflation rate. So what do we have? We got an economy that looked red hot in the in the third quarter. And by the way, in the productivity numbers, there's an output number that's kind of like real GDP, but it's non-farm business. And non-farm business productivity soared by, I think it was like 5.5%, something like that. Whereas real GDP was at 4.9%. And labor input, I think, was 1.1%. So we had a big spike up in productivity. Hourly compensation rose around 4% or so. And so unit labor costs were up by only 1.9% in the third quarter. And that, as I'll show you in a minute, is highly correlated with the CPI. CPI tracks that number really closely, actually. And so that's an encouraging development. I don't know if the market pays that much attention to that number. I know we put out a quick takes on it and made a big deal about it. Productivity is making a comeback was the title of our quick take. So as you know, we're very attuned to that variable. I don't know that the pessimistically inclined naysayers have been talking much about productivity. Maybe because they are fundamentally pessimistic. They're not inclined to see a scenario where productivity might save the day here. Productivity might be better than expected. I think we're going to see a productivity boom. So you know where I am on the optimistic side, clearly, arguing that this could still turn out to be the roaring 2020s, as unlikely as that might seem after the past few years. But all in all, the economy's hanging in there pretty well. The labor market's is really tight, and I think inflation's turning out to be transitory after all. You know, the Fed at first thought it was transitory, then changed their mind early last year and concluded that it was more persistent than they thought. And I think what we're seeing here is that inflation turned out to be quite transitory in the goods areas of the economy, and it's the services that have been more persistent, but even they are coming down, and especially rent inflation, as we've been discussing before. So the market did extremely well last week. We sent out a quick takes on the performance of the S&P 500, 400, and 600, and the sectors. And needless to say, the interest rate sensitive sectors did especially well. The REITs did well, financials did well, consumer staples did well. And in financials, we had, like double-digit increases in some areas, particularly the regional banks. So they made a nice comeback. So all of a sudden, things look pretty good. Even in the Middle East, things as awful as they look right now, they haven't deteriorated from that level of horror that we've seen over there since October 7th. And it has been a horror show between Israel and Hamas for sure. But the big fear is for investors is the geopolitical consequences. Will it become a regional war? And of course, the economic consequences on a global basis. The most direct impact that a regional war in the Middle East can have on the global economy is to push oil prices up. Instead, oil prices have actually been remarkably quiet, weak, actually. Which is it's not really that puzzling. I think the Saudi Arabians have gotten a lesson from the markets over the past few months that the market isn't going to bear $100 oil, as I think they were aiming to accomplish. China's too weak, Europe's too weak, and American drivers are sort of the oil vigilantes in the oil market. When gasoline prices spiked up in the summer, people cut back on their driving. A lot of people are working from home, and so they don't have to go out other than to, get over some cabin fever. But they did cut back on gasoline usage. And meanwhile, the high prices have caused supply to surge in the U.S. and probably some other places. So this could still turn into a regional war. There's still a lot of ugly things going on, a lot of ugly threats, and things are still hot on the border with Lebanon. I was listening to one of the many experts that are commenting on what's going on here, and it seems that Hezbollah was not given a heads up on on what Hamas was going to do, and it seems that way, anyways. And maybe it's possible that even Iran didn't get a heads up. I mean, the October 7th massacre was a total surprise. And maybe the Hamas succeeded by making it such a surprise by not sharing that information broadly with their partners, allies in the Middle East. So it's not clear that Iran wants a regional war at this point, because they certainly haven't. They may have told the Hezbollah to go ahead and start shooting aggressively, but that apparently hasn't happened. And as a matter of fact, on Friday, one of the things that was positive for the markets, anyways, is that the head of Hezbollah in Lebanon did not declare war on the United States, on Israel, I should say. And the United States has made it fairly clear by sending all the military contingents over there that if this thing becomes a broader war, the United States might be, in fact, doing some firing. But the head of Hezbollah said he supported Hamas, but he didn't say that he was joining Hamas in the whole thing. So that's where we are with regards to the geopolitical situation. And then, wait 1 minute, one of the dogs wants to come in. Bailey. Okay, so now we're all set. Got two of the three, and the third one always sleeps upstairs. So let's go and look at, as Warner Wolf once said, let's go to the videotape and look at some of these things and try to assess where we are and where we're going. Okay, so again, this is our new improved charting system. We've been slowly bringing it into the mainstream of what we do. And so you can see that we typically do this over the weekend when we got some time to make sure they're all straightened out. And then we use it for the morning briefing on Mondays. But by the end of the year, before the end of the year, we'll probably just completely cut over to the new system. I think you like it. I think you like what it looks like on the website too. So here we've got the S&P 500 and its moving averages. Jeff Gundlach was on CNBC right after Powell spoke last week, and brought to my attention, I'm sure many of you already saw this, that there was a nice little uptrend line for, I'm an amateur technician, so I draw trend lines and moving averages. I'm no more sophisticated than that. But it is interesting that we did not find support at the 200-day, and we did find support at the trend line. And then last week we found some fundamental reasons to bounce off that trend line, and now we're above the 200-day moving average. So it's looking pretty good for maybe that was our Santa Claus rally. Hope you enjoyed it. But no, I think there'll be more. I think we'll see that the economy will give mixed signals that suggest that we're back in soft landing territory, maybe 2.5% growth in the fourth quarter, and that we're back we continue to see moderation and inflation. And what we've all been wishing for on the equity side is that the bond yield won't go above 5%, and it just kind of stabilizes, which I think is what it's starting to do or about to do. Let's go here to this touch screen window here. The NASDAQ did breach its 200-day moving average just very briefly, but then bounced right back to its 50-day moving average. It's really, when you get an opportunity in the mega cap 8 and some of these other technology names, particularly in semiconductors, it looks as though investors really want to own these for the long haul, and any opportunity they get to buy them cheaper, looks like they bounce on it. So this is what we're all rooting for, I think, unless you're a hedge fund that was massively short at 5%. You got to give Bill Ackman credit. He nailed it pretty well. Very well, as a matter of fact, got out right at 5%. And he made that announcement last week on Monday. So he kind of got the ball rolling on the rally we had in the bond market by saying that he was covering his shorts. But look, in the grand scheme of things, you can stare at this thing and say, what's the big deal? What's all the excitement about? We have only dropped 50 basis points. And when you look on this chart, that's kind of the standard volatility maybe not standard, but we've seen more of that kind of volatility of late. I mean, could we be back at 5% before year end? It's conceivable, I suppose. That's the nature of this bond market. But I think after this kind of rally that we've had, people will be more inclined to view 5% as another opportunity to buy the bonds rather than to fret that they're going to go to 6%. And now keep in mind, nothing fundamentally happened with regards to the underlying problem that the bond vigilantes are still focusing on, which is the debt. There's a lot of debt. The bond vigilantes are more powerful than ever because the amount of debt is bigger than ever. And now on top of all that, we've got it compounding at a faster rate because interest rates have gone up. So I think it was Stan Druckenmiller who announced last week or recently that he was going very long the 2-year and very short at the long end of the marketplace. So last week, depending on what he held, he either came out even Steven, or else if he owned a lot more of the 2-year than he shorted the 10-year, he still did reasonably all right. But shorting the 10-year last week was certainly not a moneymaker. It was a good way to lose a lot of money. But figure 4 here looks at that point I made about inflation. And look, everybody spends a lot of time, including us, slicing and dicing the CPI, the consumption deflator, and people have kind of gone berserk about the healthcare insurance component of the CPI. I've gone berserk along with everybody else about the rent inflation component. At the end of the day, the Fed's responsible for the overall inflation rate. They're not responsible for, whether you're paying more for pet care or, other personal item care, stuff that's in the super core inflation rate. They have to focus on what they think monetary policy can have an impact on, and that's overall inflation, not individual categories. So I think it's important to keep that in mind and not get I've written a couple of times that the devil is in the details when it comes to inflation. In other words, you don't necessarily want to go there. But I'll go there and you'll go there and everybody else will go there because that's what we do when we try to analyze these indicators. But I don't know that too many people really focus on this chart, which I think is pretty nifty. It shows unit labor costs for the non-farm business sector. So that's hourly compensation divided by productivity. If hourly compensation is rising very quickly, unit labor costs are going to rise very quickly. If hourly compensation is rising very quickly, but productivity is rising just as quickly, then unit labor costs aren't going to be a problem. So we had unit labor costs on a year-over-year basis up 1.9%. Correlation with the CPI is pretty good. And that's consistent with our view that, surprise, surprise, we may actually be able to get the CPI down to 2%. I've said it before, we're already there for September. If you take out from the headline, if you take out shelter, we're at 2% on a year-over-year basis. If you take out food and energy and shelter, we're at 2%. So the CPI is already there. The consumption deflator still has a 3 handle on it, but it's heading in the right direction. So where are we with regards to the economy? I'm not quite sure where the hardlanders are. I call them now the die-hard hardlanders. And look, I'm not saying they're wrong. As you know, I got spooked a couple of times in October and raised the odds of a recession from 25 to 35%. I just want to, communicate to you that I'm not a chronic optimist, that I can't think bad thoughts. So I had a couple of bad thoughts in October, and I said and conceded that there's an increasing chance of a recession. Now, I don't know. I'm not going to lower it. But the Middle East situation, especially what happened on Friday, where Hezbollah backed off on declaring war on Israel, I thought that was an important event and might have been an indicator that the bad guys, at least from my perspective, in the Middle East, Iran and Hezbollah aren't itching for a out-and-out regional war with Israel and then America as well. So I think some of the hardlanders have been saying, well, we're less inverted now, but Look at this chart in Figure 5. The recessions happens actually when the yield curve disinverts. Well, um, that's what it looks like. But when you kind of go, have some sense of financial market history, you realize that the reason that the yield curve in the past disinverted before recessions is because the Fed raised interest rates to levels that caused a financial crisis. And that financial crisis turned into a credit crunch, which then caused a recession. So short-term rates fell. The Fed then responded by lowering short-term interest rates faster than bond yields were falling. And that's what disinverted the yield curve. That's not the situation we have now. We don't have a financial crisis. We had one in March, but the Fed dealt with that pretty well, and it knows how to play whack-a-mole with these crises pretty well. So it has yet to turn into a financial crisis. And the rally in the banks last week suggests that even investors are becoming a little less concerned about that a resumption of the banking crisis. So in the current situation, the bond yield rose faster than short-term rates because in the summer, we all, even the soft landers, realized that the economy is stronger than we thought. And the Fed hammered home the point that they were going to not cut the Fed funds rate 4 times next year, but two times as a way to communicate higher for longer. So I don't really see this as being a recession signal. We may get a coincident economic indicator later this month, which is finally negative. We haven't had a negative one for a long, long time. Every time the leading economic indicators goes down, the coincident goes up to a new high. But we may get a negative one. But look, October again, the auto strike was on. There was some weakness there, so that's going to be reflected in payroll employment, which is a CEI component. And that in turn may be reflected in retail sales, which is included as in one of the CEI components. And then production will be down because auto production was down. So the debate will go on. I mentioned Jeff Gunlap looking at the stock chart and seeing the upward trend line. He also in his interview pointed out that he thinks we're now heading for a recession early next year. So I love that kind of talk. This has been the most widely anticipated recession of all times, which is from a contrarian perspective. One of the reasons it's just not going to happen until nobody expects it. We'll try to see if we can do it, but let's move on here. So that's the 2-year and the 10-year. Mentioned it in the text. So again, the labor market's pretty good, right? Job openings in millions. They edged down. This is the job openings in millions. The red line. Sorry, they edged up, I should say. And they're still well above where they were pre-pandemic. So that's the jobs openings. And then there's this jobs plentiful series, which is in the Conference Board's survey, and you can see that that's been coming down, but it also remains elevated. So there's jobs out there. Maybe there aren't enough workers out there, so we need some productivity gains. On the supply side, we did see a little downtick in the civilian labor force participation rate, and it's still below where it was pre-pandemic. So there's still fewer people in the labor force relative to the working age population than there were before the pandemic. So that's the supply side. And you would think that with the tightening of if demand exceeds supply, you'd expect to see higher wage inflation, but the quits rate has come down. So people aren't necessarily jumping ship to go to another ship where they get paid more. Maybe workers are getting some non-pecuniary benefits that are keeping them in the same place, or maybe just that frenzy is over for a while. But wage inflation is coming down. It still has a 4 handle on it. Fed Chair Powell said he wants to see something closer to 3.0%. But then again, he said he basically made the assumption that if productivity is growing 1%, then he can tolerate 3% wage inflation because 3 minus 1 is equal to 2, and that gets him his 2% inflation target. But what if he's wrong about productivity? What if it's better than expected? Then we can tolerate 4%. 4% 4 minus 2 is 2. So let's see what happens on the productivity side. Well, speaking of productivity, that came out on Thursday, as I mentioned. Hourly compensation is another measure of wage inflation, and it's more comprehensive, but it's also more volatile. And you can see that it's also got a three handle. Well, it's got a four handle on a year-over-year basis. So here's the happy story. Brought tears to my eyes when I saw this come out. The productivity number was very strong at 4.7% at an annual rate. The year over year is 2.2. What if that's where productivity is heading? Well, I think it could be actually heading higher. I've shown you this chart before, and when I visit with you folks, I often show it. This is the pièce de résistance of the roaring 2020s. If I'm going to be right about that, look back at the end of the decade. Still got a few years here to get a productivity rebound here, and this is the growth rate in productivity on a 20-quarter basis at an annual rate. And so the red line is non-farm productivity. And you can see that it actually has been recovering since 2016, 2015, the end of 2015, it was 0.5% at an annual rate. And then before the pandemic, it got to 1.5%. I mean, a triple in productivity growth is good. It's great. Well, then the pandemic screwed everything up. And now I think we're back to seeing another productivity growth boom, which was what we had back in the 90s. We had a mini one under Reagan, but we didn't go anywhere near 4%. But you see in the 50s, we went quite high. In the 60s, we went that high. There's every reason to believe that if I'm right about a productivity boom, the technologies that are out there lend themselves to many more businesses to increase their productivity. There's no particular reason in my mind why this couldn't kind of achieve a 3.5 to 4.5% productivity boom, which would be great for growth, great for real wages, great for profits, and great for our scenario, and good for you, by the way, if you're long only. So okay, here and now, sometimes you need a magnifying glass for this. This is our earned income proxy. Look how well it tracks what wages and salaries are doing in personal income. The reason it does that is because that's exactly how the Bureau of Economic Analysis comes up with this number. Is they track the payroll number, the length of the work week, and then average hourly earnings. And so we figured that out, and we've been watching this. Every time employment comes out, that's the first thing Debbie and I calculate. And you can see here that, it's flattening out. So that's this personal income is a component of the coincident economic indicators. Payroll employment's a component. So maybe the CEI is going to give the diehard hardlanders something to get excited about, maybe. But again, October was sort of a strange month with all the things going on. So we're not particularly troubled by that, especially since we've been doing a lot of work on personal income and pointed out that non-earned sources of personal income now are equivalent to something like 60% of wages and salaries, and they're all at all-time record highs. So that's interest income, dividend income, proprietor's income, rental income, all record highs. And that's a lot of that income is being earned by older people who I think, especially the baby boomers, are now in a point in their life where they actually have a lower savings rate. They're actually spending this income. So I have left a few minutes for a few questions. Let me open it up here, and let's see. We got the duo here. That's so now we got Bailey and Max taking a snooze. Makes me want to take a snooze, but I'll wait until later. Let's have a look here, because I want to shortchange you folks on answering your. So I have a few questions here. I got 4 altogether. Let's see if I can handle them. John, hello. What is your bad case, median case, and optimistic case for the S&P for year end and 2024? And what are the factors that most affect your 3 cases? Well, that maybe you just inspired me to update our views and all that. But we're certainly on the optimistic side, feeling more better than I did in October about getting up to 4,600. I thought I started shaving it to maybe 4,400, but we're almost there. So 4,600 by year end, back to where we were basically in July. So everything got kind of turned upside down, right? At the beginning of the year, most of Wall Street was talking about a lousy first half and a better second half because they anticipated a recession in the first half. We didn't. That didn't happen, and we thought that it would be a good year. And when we got to 4,600 by July, we said, maybe we'll get a bit of a correction here, and that panned out. Got a little wobbly there when we went through the 200-day, but we found, and the market found support at that upward trend line we looked at. So 4,600, and then next year we're really delusional, far-fetched with 5,400. But our earnings numbers are also at the high end. We're still using 225 this year, 250 next year, and 270 for 2025. And those are, I think, the highest on the street, or among the highest. And that's again, that didn't look too. That was a real contrary view for this year. Let's now we got a couple more years to see how our forecasts go. The worst case is, well, go to the pessimists. They'll tell you what it is. My gardener's back there, so you may be hearing the leaf blower. I may have to close the door. Jake, I couldn't help but notice your GPT bookmark. How have those AI tools helped you in studying the market and or value assets? Oh, by the way, my Yeti's here too, in addition to Max and Bailey. And Yeti's pretty good at killing background noises. Yeah, I've tried GPT. I was really hoping that I could, stop working for a living and let GPT say, write today's morning briefing in my style. And I found that I had to spend more time editing and correcting GPT than it was worth. So, from my perspective, it's not there yet. William, the Biden administration's industrial policy is already driving malinvestment. Wind, solar, EVs, CHIPS Act may not pencil out. What happens next? Well, yeah, I think whenever the government gets involved in spending money on New Deal kind of things, I mean, you could argue that the New Deal did actually build some infrastructure that made sense. Eisenhower's building highways made a lot of sense, but a lot of this stuff that they're funding now is rather controversial and is somewhat flawed. And anyways, I'm hearing things that they may be forced to back off on some of these things, so they just simply don't work. So how does this all impact the economy? Well, it's, as you said, it's malinvestment. It's not a good use of capital. But I keep being impressed by how resilient the economy is, because it's so large, so resilient. My mantra is, look how well the economy is doing despite Washington. So let's hope that keeps working. Mike, greater use of technology could drive productivity higher. What forces could decrease productivity? Good question. I'm a little stumped because I've been spending so much time trying to convince everybody that productivity is going to make a comeback. I mean, you can always argue government policies or regulatory policies can sometimes be a negative for productivity. I'll think about it. Sounds like I'm going to have to think about it to give you a good answer on that one. But I mean, it's just more of the same. Unskilled workers. So even if you give them better tools, they really don't know how to use it. And maybe artificial intelligence is a bit hyped up, as I found from my own personal experience. Let's see. So William, plus the UAW is feeling its oat. Won't that drive even more CapEx? Well, there's your answer to productivity. If the labor unions become very powerful, and it's deja vu all over again with the 1970s, then the 1970s, labor unions accounted for 35% of the labor force. Now they're only 6%. Now let's say that the UAW success here leads them to lead get a lot more workers unionized, and they get cost of living adjustments that willy-nilly give you a pay increase, even though it has nothing to do with your employer's business. I mean, in the theoretical world of microeconomics, it makes a lot of sense that real wages should be tied to productivity. But the question is, when you take wages and divide them by a price deflator, what do you use? Do you use the CPI? I think you should be using the consumption deflator, the not the consumption deflator, but the deflator for business. That's, I'm your boss. You come into me and said the price of gas just went up. I deserve a wage increase. I said, I don't make gasoline. That's not the business we're in. I got to give you, pay you what your productivity is in inflation adjusted terms based on the prices I get. So that's kind of a quick. Okay, I'll take one last one. Ed, can you talk to the international markets and expectations for 2024? Well, the international markets, emerging markets, usually do relatively well when the global economy is doing better than the U.S. economy. Now, that doesn't look like it's going to happen anytime soon. China looks pretty weak. Europe looks pretty weak. Commodity prices are kind of sitting there. So you really need to see commodity prices pick up. You need to see the dollar weaken to really take significant bets in emerging economies. So guess what? I'm still in the stay home camp. I saw a few more of you added questions. Let's save them for next time. Thanks very much for joining me today. Have a great week, and we'll see you next week. Thanks.